Hello, welcome to the Nest Edge and welcome to 2021. We're excited to get this year kicked off and look forward to a lot of good things happening this year. First of all, the Nest Edge, we've got two webinars throughout the month. One is called the Nest Edge and the other one's called the Nest Egg, which will be in a couple more weeks. Nest Edge is all about a unique way of looking at data. So we have one webinar that's about education. The other one is about what we think about is going with the markets and the economy. So we named this because we have a unique way of looking at data, and it gives us an edge over the choppiness of the markets and the news cycles. So first of all, we want to remind everyone this is not advice. Even though we are advisors, this is not meant to be advice. This is simply an educational webinar, and use this information as you will for education to hopefully make more informed decisions. And again, also to show you how we do things, how we look at numbers, what numbers we look at, and how we make that data, how we use that data to influence our decisions in portfolio management. In this game of investing, there are many ways to lose, and there are many ways to win. We are just discussing our process. This is a conversation between our portfolio manager, Sean McDougle. Hey, Sean.
Hello.
And myself. Sean, wow, it's been a heck of a month. Let's start
it's been great so far for us.
Well, yeah, it's definitely been a heck of a month in all kinds of ways.
Yeah.
Let's start off by talking about the stability of the markets after what we've seen in the political realm last week and going on this week. I want to give our viewers and our audience kind of our thought process on what that means for the markets and what you've seen for the economy. We think that's an important question. Oh, by the way, before we launch off, I want to say one more thing to the audience. If you have a question that you want us to cover, we try to cover all questions from the audience. There's a Q&A box on the webinar. Make sure you just add your question there, and I will keep checking back on that and make sure we cover it. In the meantime, I've got a few questions that we will start discussing and add those in the future. So, yeah, back to the question, Sean.
Yeah, last week, I assume we're talking about the storming of the Capitol on Wednesday and how the markets responded and since.
Yes. Yeah, what happened then and what's happening now.
Yeah, the day of was hectic. It sold off the last few hours of the market, but Thursday and Friday, it came back strong. Okay. I mean, it really has shrugged this whole thing off. If you want just the short answer, it was a pretty much non-event. I knew something was up. I was at a chiropractic appointment, and my phone just started going zzz, and I was like, all right, well, 1 second, what in the world's going on? And I looked, I think market points wise, like everyone understands the Dow points, it was up like 400 points and then it was down like 200 points, like in the span of like 20 minutes. Like I'm not in the chiropractor very long. I go there all the time. I'm not in there very long. And in such a small window, I knew something was up. So, never seen that before. Pretty scary, just for us as a nation, no matter which way you lean politically or don't lean at all, you never want to see that. But the equity markets, currency markets, the bond markets, and commodities have really hasn't changed anything. Everything has just kind of continued on the same direction that it was.
So, thanks for giving us that update, because I was curious, and we've talked about it a little bit. I knew that some of our clients were curious about that too. In the newsletter, now I want to go back to the newsletter that everybody has received. You mentioned that the single biggest driver of everything at the moment is the evisceration of the U.S. dollar. And yep. So can you explain why Wall Street loves this?
Generally speaking, Wall Street trades, or the things that they make that's the most volume, is multinational companies that do business all over the globe. And we've talked about this, I'm a bit of a broken record on this point, but when your currency on a relative basis is cheaper than the euro, companies in Brazil are more likely to do business with U.S. companies compared to Europe because their currency is cheaper on a relative basis. And so a down dollar, in the short run, Wall Street's going to love that.
Okay. So break that down also, because you mentioned in the newsletter that you also Bitcoin and emerging markets love this. Can you talk about?
Oh, yeah, it's the same. Yeah. So Um, exact same thing, I guess you would say, with the Bitcoin. So Bitcoin, it does not have value, or I'm sorry, it does not have a balance sheet. It does not have revenues. It does not have expenses. It is a cryptocurrency, and it derives its value from the exchange rate with the US dollar. So if the US dollar is getting smoked, even if no one is doing anything with Bitcoin and no one's buying any Bitcoin, Bitcoin's going to go up. Now that gets really ramped up if there's flows throughs to the Bitcoin also, but it was just I mean, that's what we're seeing. But just to, you know, was it Sunday bleeding into Monday, Bitcoin fell 20%. I mean, so that's still a cryptocurrency. It is not a blue chip stock, or, as these narratives are liking to tell you, Bitcoin is, who knows where it's going to go? I don't know. It went up like 100% in a month, fell 20%, earlier this week. Who knows where it's going? I believe it is slightly up today. It's hovering around 35,000 of Bitcoin, which is crazy. But some people really, really believe it. Some people think it's a fad. I try not to look more than a month or two down the road. So who the hell knows? There's so many. I've heard so many narratives that are pro and con Bitcoin that it's just like, we'll see what happens. I don't know. Some of our more aggressive people have started to dip their toe in it in different ways, but it's nothing that we're going to go out and, put 10% in our models of it. It's just, it's too much unknown.
Too volatile. So what about emerging markets? And can you explain to the audience what you mean by emerging markets? Because I think some of these definitions sometimes we talk about it all the time.
Markets. So you can think of, so the developed markets, let's kind of do this. That's the US, Canada, Europe, Russia, China. China is a bit of a misnomer because it's kind of fading out of emerging markets into the developed markets. Countries that are established have very developed economies. That's developed markets. Emerging markets is going to be, it's a lot of Asia, some Middle East, but mostly the hubs of it is going to be those mid-sized countries that are really just still getting their economies up and running, and they do well in down dollar environments. Back testing wise, it doesn't mean they're going to do well every single time, but historically, when the dollar's getting beat up, it helps them.
Why does it help them? Is it just their values more in their currency?
Yeah, and that makes almost no sense because you would think, well, their currency is more expensive. That would hurt them. Yeah. But they are constantly exchanging in and out of U.S. dollars, so it does.
Okay.
Yeah, if you're in the Philippines and you're doing business with someone in Brazil, you're constantly, generally speaking, the U.S. dollar is the world currency. Right. So they are going in and out of that currency to make a trade with Brazil. And I know that's mind-numbingly, stupidly annoying, but currency markets is a whole nother bear.
Yeah. Well, that gives us a pretty good indication. I get that. So when you're traveling, but right now, when the U.S. And obviously, if COVID restrictions were off and we could travel around the world, it would cost us people in the U.S. with the U.S. dollar more money to travel because the valuation against other countries is the dollar's down.
U.S. citizens' purchasing power is going down. People that are struggling are going to be struggling even worse because not only is their value of their dollar going down, but you have commodities are going to, all the input costs, inflation is ripping, so everything's becoming more expensive. It's the double whammy of inflation.
I do want to talk about inflation in a second. Maybe we'll wrap this up in our next question, which is, what does it mean for our portfolio? So we know the dollar's down, we know markets are ripping. What does that mean for our portfolios? What are you looking to get rid of, and what have we gotten rid of, and why?
So we are completely out of, and we have been for a couple months now, all the things that we were in for like 2 years: treasuries, gold. We were long the U.S. dollar, utilities, REITs, things that are rate sensitive. And when I say like with interest rates, as they are going up, which they are, no matter what the media wants to tell you, interest rates are going up. Things that like that are things that we want to hold, and things that hate that we're trying to avoid like the plague. So growth and inflation are ripping right now. So instead of having gold, treasuries, utilities, REITs, we are in pretty much the exact opposite of that. China, tech, energy, Netherlands, financials, a lot of commodities, cattle, natural gas, corn, copper, coffee, soybean, wheat, and then a ton of, especially our more aggressive models, mid and small cap stuff. Very little treasuries or bonds as a whole. There are some treasuries out there that do, or bonds that do well with inflation, but it's very, very small percentage of the models.
So for the last few calls that we've done like this, we've been all of last year heavy in treasuries, heavy in gold, and we've traded on a few things. So this is completely different. Our portfolios have completely shifted from where they were last year, and that's because we're expecting these things to continue to grow. Correct?
The data backs it up. Yeah, the data is saying it's go time. We have a window of time here for between. There are clouds on the horizon in the summer. Now, some of that may get pulled. Expectations always gets pulled forward. But we do see there's going to be some issues in the summer, maybe late spring, but there's a window of time between now and then to where it's go time. Our most aggressive models are very aggressive right now.
What are the pitfalls during this evisceration of the US dollar? What do you mentioned a few things, interest rates going up, inflation. Can we talk about that? Like, what are some of the things that we are mindful of?
With the interest rates?
Well, what are the pitfalls of let me just start off with the first question. What are the pitfalls of the evisceration of the dollar? And I added on the inflation and added the other things.
Yeah, the pitfall, I guess it's not an immediate problem, but it's going to, it is happening. Commodities are ripping, which is most companies' largest input is they have to have something to make the widget. With inflation, everything becomes more expensive. And so unless your income is catching up, unless your income is increasing at the same rate of inflation, you have less money. Like if you make $50,000 a year, but everything's increasing by 5%, you're basically getting a pay cut of 5% every week, month, whatever time duration we're talking about. But inflation is incredibly important if you're, especially in a time right now, because our economy is waffling. It's right there now. With Biden coming in and the Senate going Democratic, or at least as of now, they have the control or House or half of it.
Before we jump into that question, I want to break up a little bit the question that you had just brought up. So if you're producing goods, and here's where commodities come in, and I just want to put this as an example because this all has to do with inflation. And for the last couple of years, we have had been told that there's no inflation. But what you just said, commodities, meaning like oil and things that are needed to produce
input
goods.
Costs. So
can you tell us what oil is doing? Yeah.
Okay. So these are just year-to-date numbers. So a week and a half old. Crude oil is up 9%. Natural gas is up 8%. Gasoline's up 9%. Heating oil is up 7%. All these soybeans up 7%. Rubber 10%. These are like massive input. Sugar 5%. Corn's up 8%. So just think about all the goods that require the things I just rambled off, and in a week and a half, they're up 5 to 10%.
Right.
And if you go back farther, a month, it's even worse. Really since November, inflation has showed up.
Okay. And this is what we want the audience and our clients to understand is that there is a shift going on. A lot of this news, political news, everything that's been happening, but underneath, there is a shift along, even though we still have high unemployment and all of these things, there is a shift going on with the commodities, which is going to cause inflation. This is the data that we're talking about that we look at to make adjustments in the portfolios so that the goal is obviously to outpace inflation. Correct?
Yeah. Oh, yeah.
Okay.
Inflation is either your friend or your worst enemy, depending on what you're holding. Our models love it right now, but it's for the majority of people, it's not good.
So now I want to unpack the question regarding stimulus because last month when we had this call, stimulus since had not been approved, and in your newsletter you mentioned that there has been more stimulus across the world. Can you give us more insight into who's received stimulus and what that means for our client portfolios?
Yeah, lately there was that. I think it's $2.5 trillion of new fresh dollars. Well, 900 was ours, and then the Europe did a bunch, and then Japan did a bunch. And I've talked about this, or we've talked about this quite a bit lately, is of the currency war that's going on. We're not the only country that was affected by COVID-19, and we're not the only country that's trying to devalue their currency and try to, prop up their own economy. So every central bank in every country all over the globe is doing the same thing at the exact same time. Lately, we've been doing a better job of it. And when I say better job of it, I mean devaluing our currency relative to everyone else's. But we're not the only show in town. Now, there has been some rebound in the dollar this week, and a lot of that, correlation is because there's a shitload more euros out there now, and a lot more Japanese yen out there right now. And so it's a dance where everyone is pumping their economy full of money. And the relative value game, you got to let it play out and see who does better turning on the printing machine, without a better way to say it.
Okay, that makes sense. Before I jump into unpacking some other things there is a question from the audience, and that's, what's the view on banks? Higher interest rates, good for banks, but what's COVID doing for loan default rates? View on the balance. So in other words, we're looking
default
at
rates, yeah.
We're looking at financials being strong, interest rates going high, but COVID's still there. And how does that, affect those default rates?
Default rates are definitely a concern, just not like I said, not in the near term. That is definitely something I have my eyes on. I'm watching default rates, mortgages, corporate, whether it be direct loans or, what's called bond yield spreads. That's something I look at every morning and 3-4 times a day to see if there's a spike there, and there really hasn't been yet. That's going to be probably one of the financials, is probably the first thing to go when we start pivoting into
our portfolios.
That. Yeah, first thing to go once we start pivoting into when those clouds start really rolling in. Whoever asked that question is absolutely thinking correctly. With rising interest rates, that is good for them, but there's going to be some cross currents. So exactly where and what you do and the timing and the sizing is super important, because a lot of people are going to get head faked pretty good this year, because right now it looks really good. Like it's been a couple of years since I've been in this go mode where it's almost like everything I buy right now is going up. Like right. I am trimming gains almost every single day.
Okay. So back to stimulus. We were talking about stimulus around the world. We're just pumping a lot more money into the world economy. So what does that mean for the client portfolios?
Doing great. This might be the best start of a calendar year so far. Okay. Yeah, I mean, I'm just skimming back through 2018, and now I'm like, our average model's up 3.5 year to date, which is a year and a half. 2 weeks. Yeah. Our more aggressive ones are up close to 8. I mean,
wow.
The S&P's up 1.5. It's yeah. Okay. I mean, and like I said, I'm trimming gains, trim and plant, trim and prune. Plant those gains, because it's gonna go quick at some point. We still have a little bit of leeway, but this year has been a great start so far. And really, it's been the last month or two. We finished strong last year. We caught this commodity wave, and it's kind of continued on its way up.
So last month we talked about several media outlets are saying that 2021 could be a big boom in the economy and the markets, and you alluded to these clouds maybe in the summertime. Are you feeling the same about this? And can we go into unpack that a little bit more?
The same as what the media is saying?
Yeah. So last month we talked about, it's going to be strong for the first quarter foreseeable, maybe second quarter, and then there's clouds. Yep. Now that a month has passed by, I just wanted to give us an update to that question.
Okay. Nothing's changed. The lazy narrative of COVID's over, the economy's going to go back to normal, and everything's going to reset to February 19th, 2020 is just very lazy because they just see everything in such a linear world. Like, like that's just not reality. And the big problem is we had records amount of debt coming into COVID, and we got through it by adding more debt, both on the the government side, but more importantly on the corporate America side. 2020 was the record year for new debt issuance for S&P 500 companies. And that went on top of record numbers of, debt on their balance sheets. So it's like if you made $100,000, but you had $150,000 on credit cards. Like, yeah, you make money, you're going to make money, but you have this big noose around your, around your neck. We're not going to rip roar. Especially when I always talk about comps. When the comps get tougher, this next month or two, they're going to get real easy to beat the year-over-year comps because we're about to walk into the period of time when COVID started. So It's going to be really easy to beat those comps. But once we get a month or two.
For those that don't understand comps, that means comparison over last year. So where we were a year ago to this year, we're always trying to beat the comp. And so when Sean says comp, it's where were the markets last year and are they better this year? And so just to unpack what he said a little bit is because COVID just started around March of last year and the economy started doing this, we should be able to
really easy to beat those numbers. Yeah. Really easy. Companies, corporate America is going to have no problem beat those numbers. It's the massive rebound that it had in late spring, early summer that they're going to have to comp up against is going to be. That does not mean we know for sure things are going to implode. We really don't know. And I hope everyone can appreciate and respect me saying that because, we don't. Anything further out than 30 days, 30 to 60 days, I have a decent idea. And then anything over 60 or 90 days, we have theories and we're going off of comps and what, trends are, but you don't know. It's hopefully everyone can appreciate me being honest about that because anyone that says they know for sure what's going to happen in 2021 is just
right. There's no telling.
Okay.
We have ideas based on where the paths are going, what the laws happen, and based on comparisons over last
back
year.
Tests, we have an idea, but it does not mean we know.
Correct.
So it's definitely we'll see.
Going to go back to another question from the audience, and of course this is not advice here, but there's a question that says, with bank CDs paying hardly anything, what investments would be a better return now with some degree of certainty? So unpacking that question a little bit is right now they're in a very safe conservative CD that is paying hardly anything. Is there anything other than that is safe conservative that they could get a little higher return? What would your answer to that be?
If they're getting 1% off a CD, is that what that? They're really getting one?
Well, no, they simply said
nothing,
paying hardly anything. Yeah.
Yeah. Well, yeah. I'd imagine that with that degree of safety,
and duration, I guess, right? Because so let me, I'm going to dive in and talk about this question a little bit. So the thing about bank CDs is that they have a time frame with them, and why it's hard for Sean to really put his finger on that question is everything that Sean does is fluid. So he can change in and out every single day. And as we've had these conversations, we moved from all these really safe gold and things that are treasuries that are considered to be really safe, but they're in a highly liquid investment account, so he can sell the next day if he needs to. The thing with a CD is a little bit different because a CD typically has a time. It's a 1 year, it's a 6 month. They're short as 3 month, 3 months, 6 month, 1 year, 5 year, all of these types of kind of time frames. And so the goal of a bank is to hang on to your money for an extended period of time. And what the bank is assuming is we'll take on whatever interest rate risk there are, but we're going to pay you this set rate, which is a lot lower than if you use other kinds of vehicles. And so to answer that question, I'd have to say that there's probably not any degree of certainty right now. The problem with banks and the problem with other types of vehicles that are using fixed rates for a period of certainty at the moment is that we are in a complete state of flux in this market at the moment. And many of these institutions are depending not on the markets that go up and down, but they're depending on interest rate hikes that the Fed does. And until those things happen, they can't really adjust their rates, or any other fixed product can adjust their rates until they start seeing these fixed rates start climbing again. And so that may be, months from now, a year from now. I mean, there's going to be rate increases, but not until then. So I think that sums up that answer. Do you have anything to add to that?
No, that's a long-winded answer of, nothing that's actively traded. CDs are structured products that have guarantees. If you're looking for something that's daily liquid, there's nothing, just because it's probable that we're going to have the year is going to start out one way and around summer it's going to completely change. There's nothing that I could say, oh, just go buy ticker SPY and hold it throughout the year. That might work. I doubt it. But,
I'll tell you at the next year, this time.
Yeah. Things move so fast. And if it's actively traded, I would say go an annuity. If you're looking for absolute guarantees, annuities have downturn problems too. Right. Annuities got problems too because the insurance companies got problems.
Right. Insurance companies got problems because of bond rates, because the same thing we just talked about. Insurance companies structure their entire offerings around bonds. And with interest rates being low for such a long period of time, they are having issues trying to figure out how they're going to pay for the guarantees that they've already offered. So I don't see those coming back actively really strong. They have minimums that they can pay, but I think that
anything that there's no. I was trying to give not a great answer to that question. Good question.
Yeah, it's a great question. Traditionally, I would have said annuities would have been an alternative to CDs, but with what we're seeing now, they have had an interest rate problem for a long time, not just a short period of time. And that's causing stability issues within annuities companies in a lot of them, not all of them, but we don't know which ones, right? So it's like, here's this
you usually find out way too late.
And so that's the issue with that. I think that if you are the individual that needs to be in CDs, I'd say write it out and know that interest rates are going to start rising over time. And it could be, 6 months, it could be a year, but interest rates will start rising. So I would say if that's the investment that you choose, make your CDs short, make them 6 months, even if they're not paying you much, because you can renew in 6 months.
Flexibility.
Have more flexibility.
Yeah. Good idea.
Okay.
Dan.
Do what?
Good idea, Dan. I like that. Do a little bond ladder.
I've been doing this for a while too. Even though you're a portfolio guy,
no. That's a great idea. I wish I thought of it. Good idea.
So, one other question on the thought about Wall Street, and now we're in a political environment. Now that something that happened in this last month is Democrats have full control, so they've got House and the Senate and the presidency. So what does Wall Street think about that? Because that was one of the bigger concerns pre-elections is that, Wall Street had some issues. So can you tell me what they're thinking?
In the immediate short run, they know the money truck's coming. More printing. The Democrats can, assuming all the Democrats on the Senate House, because they need every Democrat to vote one way. It's 50-50, but they get the tiebreaker with Harris. So, they can do whatever they want within reason. Now, that doesn't. If it's something wild, if one Democrat goes the other way, then it doesn't matter.
Then you have to get that many more Republicans to jump on ship.
Which if you're doing something wild, good luck for that. So, in the short run, Wall Street, and I'm speaking specifically U.S. domestic equities, they're excited because they know more money, more support's coming. There's probably going to be another round of stimulus checks here very soon. Biden himself, when they signed off, got the $600 ahead out the door. He says, this is just a down payment. I'd be shocked if we didn't have another round of like $1,400 to get up to that 2,000 number, which is such an arbitrary number, but that's just kind of what has been thrown out there. The reality is also eventually Wall Street's going to wake up to, once they get past this, they're drunk from this cash craze wave, taxes are going up. Right. That's very real. Corporate tax reform is going to get Trump changed that thing around a lot. So we'll see what changes there. There's been some cool things that's been floated out there with, but I don't know. Tax reform is something that can spook the street very quickly. So short run, everything's great. The gravy train is there, and we're going to ride this wave. And I want to duck out of this party at about the 7th inning.
Got it. That makes sense. And so for us, that means we'll start making moves that captures the gain, but starts making other kinds of investments.
Yeah. We'll start shifting. I'm always trying to be a month or two ahead. So again, I'm trying to roll, the second I feel like everyone is coming to where I am, I get nervous. Like, oh, we got to move.
Makes sense.
You don't want to, if you're standing in a room and everyone's standing around you, that's generally a bad place to be.
Makes sense. Well, Sean, it's been great chatting with you. It's already 1:02, so we went 2 minutes over. Apologies to everyone else. We said this was everybody in the audience. Yes, we try to cover a lot in 30 minutes to give you a really good amount of information to digest. We'll be putting a summary of this on our website and try to get a video up on our website as well. So these are all things that we're working on the other side of business, is trying to make sure we have a lot more of this available for people to do more research. And as always, if you've got questions, feel free to info@nestfinancial.net. Please send us an email and we'll be happy to help. Once again, this is not investment advice, and it has not been investment advice, rather a conversation on how we do things and what we look at. This is an education in nature only. If you, however, want to discuss how we do things, interested in anything else we can help you with, please let us know. Thank you very much and have a great rest of your day.